Hi, so welcome to Module 9, Business Ethics. At the end of this module, you should be able to explain the concept of ethical behavior by both organization and the accountants. You should be able to explain ethical problems facing organizations. You should be able to explain the various concepts of corporate governance. Then you should be able to explain the personal and professional qualities of the professional accountant. So what is business ethics, or what we call corporate ethics? Business or corporate ethics is a form of applied ethic or professional ethic that examines ethical principles and moral or ethical problems that arises in a business environment. It applies to all aspects of an organization or businesses, and it relates to the conduct of individual and the entire organization. So when we say ethical behavior, we are talking about the moral behavior, the way that acceptable behavior of organizations and their employees within the respective industry that they are in. Now, to look at this moral behavior, there are what we call corporate governance concepts, which companies adhere to, which guides how businesses behave, so that we can now call these businesses, which employees must also exhibit, so that we can now call employees or businesses as behaving ethically within the organization or within the industry. These governance principles include issues such as fairness. What is fairness? This means directors must have systems in place, must have systems and value that take into account everyone who has legitimate interest in the company. In other words, fairness means that in order for a business to be seen as ethically or as behaving ethical or having an ethical behavior, or having a good moral behavior, it means that the organization must treat all stakeholders equally. That is what we call fairness, okay? Treating all stakeholders equally. The second one is about openness or transparency. This means open and clear disclosure of relevant information to all stakeholders and not concealing information when it may affect decisions, okay? So openness and transparency simply means that the management, the organization, must not conceal any information that will affect stakeholders in the decisions that they make about the organization. Now, when we talk about disclosure or being transparent, organizations must be transparent through their financial statements, through their notes to their accounts, which includes directors' reports and then financial reviews, audit reports, among others. So that is what we mean by transparency. That is not concealing information. That is providing all stakeholders with various or vital or relevant information in order to enable them to make their decision. Why is it important for transparency or for openness as part of an ethical or the ethical behavior of an organization? One, to solve the agency problem, right? Because management are put there by the shareholders, so they must not hide any information, they must not conceal any information, they must be open to the shareholders and provide them with the vital information that they require. Two is to confirm the level or strength of internal controls for reliability. So in order to ensure that internal control systems are working well, there has to be an open system in place so that we will be able to understand and gather information so that we won't conceal any information. Then also, when an organization practices openness and it's transparent in its business dealings, then it will also increase the market share of the company in that order. However, there are circumstances under which companies must conceal some information in that order. So they may not be able to include those information in their published financial statement, in their published review statement. Some of these information include the future strategy of the company. So what the business wants to do in the future, they can't disclose that to stakeholders. They can't disclose that to the outside world. They may disclose that to the shareholders, but they can't disclose that to the outside other stakeholders, customers or suppliers. If not, it may easily be copied by other competitors in the industry. Or two, confidential issues relating to individuals, like publishing the financial statement and publishing that these are the salary of board of directors. All these things are not really necessary. They are confidential information, but those ones are concealed by an organization. The next one is probity or integrity. This means telling the truth and not misleading shareholders and other stakeholders. So management must behave in an integral manner. They have to be people of integrity, so they must tell the truth. They must not mislead the shareholders and other stakeholders in that order. They should say that we sold this thing for this, we made this amount of profit. They shouldn't hide or make any secret profit in that order. That is what we mean by to be honest. Then responsibility. This means management accepting the credit and blame for their governance decisions. It means that in order to show that the business is behaving well in a moral manner, the business must take responsibility for any action that it takes, for any policy that it put in place. Management must take the blame or must take the credit for any governance decision that they make, whether it makes the business successful or it doesn't make the business successful. It means management must literally own the decisions that they make in that order. Now, the next one is about accountability. This refers to whether the organization and its directors are answerable in some way for the consequences of their actions. So, they must take responsibility, then they must be accountable. Somebody must account, they must account to somebody, someone must ask them questions about it in that order. Now, the UK Cadre report stressed on making accountability work in the responsibility of both parties, that is the shareholders or the stakeholders, and then the directors of the company. Now, as we move forward, we will be looking at various reports that have developed in relation to business ethics and then governance. One of these reports is the South Africa King report, and the other report is the UK Cadbury report. As we go ahead, we'll be explaining all these reports as we continue. Next is about reputation. This means how an organization fulfills other principles of corporate governance. It is often a very valuable asset of an organization. So the reputation has to do with how the business behaves generally, what image the business has in the eyes of the stakeholders, in the eyes of employees, in the eyes of the public, in the eyes of government, in that order. The next one is judgment. This means that the board making decisions that enhances the prosperity of the organization. Now, this is to ensure that the management exercise some level of discretion and judgment so that they only make decisions that benefit the entire organization and not necessarily themselves. Okay, that is what judgment is about. Then we can talk about integrity. This means management must be straightforward and must in their dealing and must provide every information clearly in that order. Now, integrity, probity, honesty, they are all together in the same issue. So these are what we refer to as the concepts that governs, or the corporate governance concepts that tells or directs an organization in order to behave ethically in the industry to gain a competitive advantage. The next thing we want to look at is the global ethical environment. Ethics and morality are about right and wrong behavior. So when we talk about when we talk about ethics, it's about right and wrong behavior of the organization and its employees. Western thoughts about ethics is based on two ideas: duty and consequences. Ethics is also influenced by concepts of virtues and rights. Now, organizations always have complexity in dealing with political and then the social environment. However, while the political environment consists of laws, regulations, and government agencies, the social environment consists of the customers, the attitudes, the belief, the level of education of citizens, among other things. So based on this, ethics can be based on consequences or ethics can be based on duty. So let's look at ethics based on consequences. This approach judges actions by reference to their outcomes. In other words, we will say management acted right, or we will say the employees acted right by looking at the outcome of the decisions that they made. So if the decision they made has a positive outcome, then that is what we call ethics based on what? Consequences. In other words, what is the consequence? What's the outcome? What's the result of the strategy of the decision that the organization made? Under these ethics based on consequences, we can talk about what we call utilitarianism. This refers to choosing actions that is likely to result in the greatest good for the greatest number of people. So with this kind of concept, it is where management or the organization undertakes decisions that affect the general public all other things being equal. It affects a large number of what? People. Next one is about egoism. It states that an act is ethically justified if the decision maker freely decides to pursue their own short-term desire or long-term desire. So that is egoism. If the if management or the individual making the decision freely makes the decision and pursue a certain goal, either in the long term or in the short term, that is also ethic based on consequences. But there are criticism about this kind of concept. That means that it is usually shortened. So management will take decision and say that, okay, we want to make profit this year. So they undertake some various decisions. We want to pay our employees well this year. We want to increase profit. So we pay our employees. We buy vehicle. We employ a lot of marketing staff. So they sell the products and the year they made profit. But in the long term, they borrowed money to satisfy all these things. And so it affects the organizations. Okay. So even though it is able to achieve, we are able to see the outcome in the short term. In the long term, it affects the operations of the organization. And then the last one under ethics based on consequences is called pluralism. This concept states that different views may exist on morality. It means that the consideration must be based on different ranges. So pluralism simply means that there are various views that exist between what is ethical or what is moral, because what is moral here might not be moral there. What is acceptable somewhere cannot be acceptable or may not be acceptable in another place. So it means that organizations must look at the society they are in, the government that is in power, the various kind of behavior that is in the environment, the beliefs and the norms in the environment, in order for them to make decisions to get the best outcome of the decision. Because what is ethically right in one place may not necessarily be right in another place. What may be acceptable in one society, it may not necessarily be acceptable in another society. So that is what we mean by pluralism. Then the next classes of ethics is based on duty, or what we call deontology. Under this one, we have what we call the relativism. This refers to the view that a wide variety of acceptable ethical beliefs and practice exist. That the ethics that are most appropriate in given situation depends on the condition at the time. So relativism simply means that we judge whether something is ethical. We judge whether the organization acts ethically or is acting ethically, it's acting morally when we take into consideration the situation at hand, the conditions at hand, the circumstances at hand, before we can judge whether what the organization is undertaking is ethical or is moral. Then we come to the Absolute Theism. This is the view that there is an unchanging set of ethical principles that will apply in all circumstances, at all time, in all societies. Now, so even though there is a pluralism, which means that there are various views, there are certain things, unchanging set of principles that is acceptable in all societies, like murder. Murder is illegal or is unethical in various society. Like corruption, it is unethical in various societies. So irrespective of where you are, irrespective of the environment you find yourself in, corruption is unethical, right? So it's a general set of principles that is accepted throughout everywhere, irrespective of the circumstance or the condition. Now, so that is about looking at the ethical, the global nature of ethics. Now let's look at the ethical problems that are facing managers. Now managers, because of globalization, are faced with a lot of ethical issues. Basically, there are two of these issues. That is a conflict of interest among stakeholders, and then the payments made by the companies to government or municipal officials. So in order to look at ethical problems facing managers, there are four of these problems that managers face. One is about extortion. Now, some officials may threaten to seize or to bring closure of a company or a business if some amount of money is not paid. It is called extortion. So even though the management knows that what the money they are paying is illegal, is not right, because of the threat that they have received from these government officials or from these officials, they would have to what? Pay the money. They would have to still give out the money. So it is an ethical problem that managers face, the extortion. 2 has to do with bribery. This refers to the payment for services which a company is not legally entitled to. So sometimes there are activities that a company is not legally entitled to, but they would have to, they want to undertake it. So they will go bribe, they will go pay money so that they will be accepted in order to undertake what has to be undertaken. Then grease money. That's the next one. Now, grease money are payments made to right people in the country to oil the machinery of what? Bureaucracy. Like for instance, you want to win a contract, then you have to pay some money to some people, like put in some money so that the system can work efficiently or effectively, or you go and pay some money, or you are requesting for something. But the process is taking longer, they are delaying. But when you put some white envelope down, the process will begin to go ahead in that order. They work speedily with that. That is what we call grease money. And management is faced with the threat of making such payments so that they can enable the business to undertake activities in that order. And the last one is what? Gifts. Now, sometimes there are some countries or some cultures that going to see leaders or people in authority, you must go there with some gift. Some example, countries like China, gifts are regarded as essential part of civilized negotiation, and companies may adopt this in such cultures, even though it may appear dubious by other countries. No, so in other countries, when you are going to visit or see people in authority, you can't go there with gifts, but it is seen as something that is normal in some cultures. So it is also an ethical problem that management faces in that order. Now, so if these are some of the ethical problems that management faces, then how will the organization manage these ethics? Okay, so managing ethics. Then to be able to answer that question, we will borrow the thoughts of Lynn Payne, who is from Harvard Business Review. She suggests that there are 2 approaches to management of ethics. So the suggestion that they made there, we're going to be looking at that. Management of ethics can be based on what we call compliance approach or what we call integrity-based approach. The compliance approach is the primary design. It is where the organization acts within the letters of the law. So compliance approach simply means you don't do what the law has stated that you shouldn't do. That is called compliance-based approach. So in order to be regarded as an ethical institute, in order to be regarded as a moral organization, the organization are going to act in the letter of the law. Don't pay bribe, they won't pay bribe. Do this, they will do that. Pay this amount of money, that is what they will pay. So they will try as much as possible to act within the letter of the law. Then the next one is the integrity base. This approach combines concerns for law with an emphasis on managerial responsibility for ethical behavior. So this is where the organization has an approach that it is not only about following what the letter of the law is, but it's about following what is generally acceptable by the society. So it is not necessarily about only the law, but it's about how the organization acts in general, so that aside satisfying the law, we will satisfy the environment as well in that order. So that is what you have to understand when it comes to managing ethics. Then the next slide we want to consider is accountants and ethics. Now, as a professional accountant, your values and attitudes flow through everything you do professionally. The accountants contribute to the trust in the wider community, and the community puts a much confidence in the profession of the accountant. So as such, we will have to look at the ethical behavior of the accountant. To be able to look at the ethical behavior of the accountant, we are going to look at the fundamental principles of the Eifel Code of Ethics and Conduct, which has been adopted by the Institute of Chartered Accountants, because the Institute of Chartered Accountants Ghana is also a member of Eifel. So these codes apply to all accountants who graduate or become business leaders through the Institute of Chartered Accountants Ghana. What are these principles? The first one is called integrity. This means that accountants must be straightforward, they must be honest in all their professional work. That is, they must stand for what they believe to be right and do not stand blind eye. So they must be straightforward, they must be honest, they must do everything professionally. So if you know something is unethical, as an accountant, you don't do it. The next one is objectivity. That is, the accountant should not allow bias or self-interest or conflict of interest to influence professional judgments or conclusions that are made in relation to the organization. Then also professional competencies and due care. That is, the accountant must carry out the work to proper standards. We don't scheme, we keep up to date with changes in legislation, methodologies, and regulations. Then confidentiality. The accountant must not disclose information received through their professional work without permission of the one from whom they receive the information. Then professional behavior, which means that the accountants must make sure that they comply with laws, they comply with regulations, that they do not act in a way that brings the ICA Ghana into what? Discredit, and the accountancy profession into discredit. So that is what we mean by the fundamental principles that accountants must follow in order to act ethically within the organization. Then the next set of things to talk about is about the personal and professional qualities expected of our accountants. What are the personal qualities of accountants? The first one is that they must be reliable. Second one, they must be responsible. That is, they must be responsible for their action. Timeliness, right? You must be time bound. You must act or meet the objective for which that you are supposed to be there on time. Courtesy, that is, you should conduct yourself with consideration towards the clients. So you must respect the rights of other people in that order. Then respect. The accountants must respect others in their relationship in that order. So these are some personal qualities of the accountant. Reliable, people must be able to take, or you must meet the standards of your work. You must be responsible, there must be a timely, you must be time bound. Courtesy, then you must respect other people there. Then professional qualities of the accountant. Independence, okay? As an accountant, you must be independent both in appearance and also in thoughts. What it means is that the accountant must be able to offer or make unbiased judgments in that order. You must be independent. You must not be influenced by anybody. Skepticism, that means that the accountant must have a questioning mind. You don't just take something that management tells you. You must ask yourself, why did management do that? You must find out why management is doing what they are doing. That is called professional skepticism. Then accountability is there, and then social responsibility, because you must remember that as an accountant, you are not only responsible to the shareholder, you are not only responsible to or accountable to management, you are accountable to the whole environment, to the whole public, because your work is going to be trusted by the entire public. However, there are some things that threatens or that acts as threats to professional ethics of the accountants. The first one is called the self-interest threat. So this is where the accountant has some interest in the company that they are working with. That is, they can have financial interest in relation to having shares in the company in that order, or they can have some interest in the company by having loans, or the company guaranteeing for the loan for them in that order. That is about self-interest. Then we have what we call the self-review threat. Self-review threat. Self-review threat simply means that where the accountant is auditing or reviewing the financial statement that he has prepared. In other words, you are the auditor of the company and you are the same person who prepared the financial statement of the company. So if you are the auditor and you are the same person who prepared the financial statement, then that will be a threat, because you believe in yourself and you know the work you did. There will not be any mistake in the work. So that is a threat to professional ethics. Then advocacy threats. This is where the auditor, the accountant, is acting in a way to promote the auditors. In other words, the audit firm can sponsor the firm or can help the organization to be able to get listing on the stock exchange markets, among other things. Then also familiarity threats. This is as a result of having a long-term relationship with the audit firm. So it is advised that auditors are rotated after a certain period of time during the audit work or when the audit work is undertaken. And then the last one is the intimidation threat. This is a threat that if you don't do what management is requiring or requesting you to do, you are going to lose what? Future contracts from the organization. So for instance, if you are an auditor of a firm and you go there and you find out something and they tell you that keep quiet, don't talk about it, and you'll be afraid, because if you talk about it, you are likely to lose contracts, you are likely to lose that job, and it deters the assurance team from what? Acting properly. So you are intimidated when it comes to making initiative or making decisions about the organization. So these are what you have to understand when it comes to business ethics in that order. All the things are contained in the material. You can read them on order. You can read them in that order, and then if you have any problem as well, you know what to do. You ping me and I'll come in and answer any question that you may be having. So I will see you in the next module.